The things to think about here are continued economic strength. I think that we've seen the probability of a Fed rate hike in December increase over the last couple of weeks. Not surprising, especially given the small business optimism number that we saw. I think that from a tariff and trade perspective, we're continuing to see parts of the market like industrials that are beset by these tariff concerns. But technology stocks have been doing a bit better over the last couple of days. We have the social networking names are still under a little bit of fire, but I think we're seeing that renewed strength in technology and some evidence that this economic expansion can continue even longer than we thought.
James, you got the yield on the 2-year Treasury at a new 10-year high today. How concerned should we be over possible inversion of yield curve? And for the investors that have part of their portfolios invested in fixed income right now, what do they do now?
Well, as you allude to, we have now a 2-year Treasury that's roughly double what the 10-year was just 2 years ago. So that shorter intermediate part of the risk-free space, if you will, actually looks pretty compelling and attractive. The issue of inversion is really going to be more of a 3-month bill or the LIBOR rate to the 10-year Treasury. That's when things get really dicey for the economy, and we're still around 100 basis points away from that. So I think we've got a couple more Fed moves before the yield curve inversion really moves front and center into the Fed's thinking.
Rick, talk us through the moves we've seen late yesterday and today in terms of the U.S. yield curve. Steepening again a little bit today?
Yeah, but it really mostly are parallel shifts the last couple of days. We see virtually the same intensity on the short end as we do on the long end. For a while today, all maturities were up several basis points. There's some wiggles to it, but all in all, as you were just discussing, I mean, the inversions are probably going to happen in other parts of the curve, as our guest pointed out. Right now, there's only 3.5 basis points between 7 and 10, so obviously close maturities. But I think that the job of how we deal with all of these issues in the yield curve is going to fall squarely on the shoulders of Jay Powell and company. The idea of why the distorted signals shouldn't potentially put the fear in God in an investor is going to be the Fed's job to communicate, because for all practical purposes, it's the Fed job that we need to communicate the issue at all.
Shannon, we had Ray Dalio on Squawk Box this morning, talked about potentially the need to take a more defensive tone in terms of investing right now. Do you agree?
I don't think the economic data points to that. I think that taking a more conservative tone or a defensive tone, where does that leave us? Into staples, utilities, REITs? None of those seem all that attractive for us right now. We're still looking for earnings growth, and although that's going to start to slow, I think it's going to be in the names that we've seen that have led this rally so far, technology, and we like healthcare here as well.